The most popular income ETF on the planet paid 8% last year. Three funds nobody talks about paid the same yield and returned 30% on top of it. $45 billion in assets, JP Morgan's name on the label, monthly dividends hitting your account like clockwork. Still the wrong choice. JEPI isn't a scam, it's something more dangerous, a fund that feels safe enough to stop you from asking better questions. Popular and optimal are not the same thing. Last year, that gap cost the average JEPI investor nearly 20 percentage points. 20 points. On 100K, that's $19,500. On 500K, that's $97,500. Vanished, not to a crash, not to bad luck, but to three quieter funds with a better engine. I'm naming all three with the exact numbers right now. Part 1. The problem with JEPI. JEPI is not a bad fund. I want to say that clearly because what I'm about to tell you isn't about bad design. It's about the wrong tool for the wrong moment. In 2022, the S&P 500 fell 18%. JEPI dropped half that. Real protection, real value. That was 3 years ago. The market has been running ever since, and JEPI, by design, cannot run with it. Over the last 12 months, JEPI returned 8.44%. The S&P 500 returned 27.94%. That's a 19.5-point gap. Not bad luck, not a crash, structure. Here's how it works. JEPI funds your monthly income by selling away its own upside. It writes synthetic covered calls on the S&P 500. The premium from those options is your monthly check. In a flat or falling market, that's genius. In a bull market, you're copying your gains to pay yourself income you didn't need to trade for. The fund is literally selling tomorrow's growth to mail you a check today. Most people never see this. They watch the deposits hit every month and feel like the system is working. They're not looking at NAV. They're not calculating total return. They're mistaking income for performance. That's the trap, not the yield, the feeling the yield creates. Here's what it cost. $100,000 in JEPI last year is $8,440. $100,000 in SPY is $27,940. That's $19,500 gone. On 500K, that's $97,740. In 1 year, not a rounding error, a car, a year of retirement contributions, real money, lost to comfort. And we haven't touched taxes yet. That part's worse. Part 2. How the better funds are built differently. Before I name the three funds, I need to show you the mechanism, because a ticker without a framework is just a hot tip, and hot tips are how people end up in JEPI in the first place. The concept you need is NAV erosion. It's not dramatic, it doesn't show up in one bad month, it just quietly hollows out your account while the yield keeps you distracted. Here's how it happens. Aggressive covered call ETFs write at the money calls, weekly expirations, maximum premium extraction. The yield looks incredible, but they're capping every rally every month, and when the market runs, the fund can't follow. Share price drifts down, distributions continue. At some point, you realize the fund has been paying you back your own money and calling it income. The better funds write differently. Calls 10 to 15% out of the money, longer expirations, volatility-adjusted positioning. They give up a little yield to keep the engine intact. The NAV breathes, it compounds. Income comes in and the principal doesn't bleed. That's the only split that matters. Income that builds wealth versus income that disguises its own decay. One fund is in column A, three funds are in column B. Let's go.
Number 3. RSPA. Worst name in finance, best kept secret in income investing. The full name is the Invesco S&P 500 Equal Weight Income Advantage ETF. You will never remember that. Remember this instead. It's the only income ETF on this list that doesn't let 5 tech stocks decide your retirement. Here's the difference. The standard S&P 500 is market cap weighted, meaning Apple, Microsoft, and Nvidia alone make up nearly a third of your diversified index fund. When those three stumble, the whole index bleeds. RSPA tracks the equal weight S&P 500. Every company gets the same vote. Your janitor stock carries as much weight as your AI darling. That structural shift changes everything about how the options overlay behaves. Because you're not writing calls on a top-heavy index, you're writing them on 500 companies with broadly distributed risk.
The upside isn't capped by whether Jensen Hong had a good quarter. The numbers, as of May 2026, RSPA yields 9.12%, with NAV appreciation of 9.01% since inception, a year-to-date total return of 5.43%, and an expense ratio of just 0.29%. This fund launched in July 2024. It's barely 2 years old, and it's already eating JEPI's lunch. The trade-off is real. When Nvidia goes vertical and mega caps dominate, RSPA trails. It's not built for that market. It's built for every other market. If you want income without your entire portfolio riding on 5 tickers, this is where you start. Number 2, QDVO. And this is where most income investors' instincts will tell them to stop, and those instincts will be wrong. QDVO is actively managed. I know, that word makes index investors twitch, but stay with me because the active management here isn't a bug, it's the entire product. Most covered call funds are mechanical. Same strategy every month on every position regardless of market conditions. That's not a strategy, that's a schedule. QDVO is different. The CWP team runs a concentrated book, 20 to 40 large cap growth stocks screened hard for earnings quality, cash flow, and relative strength. Then they write covered calls, tactically. When implied volatility is elevated and the options market is paying richly, they write. When the market is running and surrendering upside would cost more than the premium earns, they don't. That discretion, knowing when not to write, is what every mechanical fund is incapable of doing, and it shows in the returns. QDVO delivered a 31.24% total return over the last 12 months, with a yield of 9.93%, an expense ratio of just 0.55%, and a concentrated portfolio of 20 to 40 holdings. On the expense ratio, QDVO costs 0.55%. JEPI costs 0.35%. QDVO returned 31%. Do the math yourself. The risk is real. 20 to 40 stocks means concentration, and concentration means when something blows up, you feel it. This fund will punish you for owning it blindly. It will reward you for understanding what's in it. That's not a warning, that's the pitch. And at number 1, GPIQ, Goldman Sachs Nasdaq 100 Premium Income ETF. I'll be honest, when I first looked at this fund, I almost dismissed it because of the name. Goldman Sachs Nasdaq 100 Premium Income. It sounds like a committee designed it. But the performance data stopped me cold. Over the past 12 months, 37.05% total return, yield 9.39%, NAV appreciation since inception positive 56.67%, expense ratio 0.29%, same as RSPA, cheaper than QDVO. Let me say that total return number again, 37% in 12 months from a covered call ETF. Here's the structural reason it's possible. GPIQ writes covered calls on individual Nasdaq 100 stocks, names like Nvidia, Apple, Microsoft. The implied volatility on tech stocks is significantly higher than broad market volatility, meaning the options premiums are richer. GPIQ captures more income per dollar of upside surrendered than a fund writing calls on the boring defensive stocks JEPI holds. And Goldman's option strategy uses flexible strike selection, not the rigid mechanical approach you see in funds like QILD. They adjust based on market conditions. When volatility spikes and the VIX runs up, they can extract more premium without capping more upside. When things are calm, they calibrate accordingly. The trade-off is tech concentration. GPIQ's portfolio is over 53% technology, with another 15% in communication services. This is essentially a bet that the Nasdaq 100's top names keep compounding over time, just with income layered on top. For income investors who are comfortable with tech exposure and have a multi-year horizon, the combination of a nearly 10% yield, sub 0.3% expense ratio, and a track record that's beaten JEPI by 28 percentage points in the past year makes this one of the most compelling income funds in the entire ETF universe right now. The side-by-side reality check. Let's put all 4 side by side. JEPI, 8.44% total return,
8.44% yield. Minimal NAV growth, $45.6 billion in assets. RSPA, 5.43% year-to-date, 9.12% yield, NAV up 9% since inception, $785.4 million in assets. QDVO, 31.24% total return, 9.93% yield, and GPIQ, 37.05% total return, 9.39% yield, NAV up 56.67% since inception, $4.14 billion in assets. $45 billion. Look at that number. Now look at the returns next to it. JEPI's AUM is not evidence of quality. It's evidence of marketing, of being first, of what happens when a fund gets recommended on a Reddit 10,000 times and nobody stops to ask if it's actually the best option or just the most familiar one. Familiarity is not a strategy. These three funds never needed your recognition to perform. They just needed the market and time. One thing before you open your broker job. Nothing in this video is a guaranteed winner. GPIQ is 53% tech. A NASDAQ drawdown will hurt. QDVO is only as good as the humans running it. RSPA has 2 years of history. Past performance is not a promise. It's evidence. Evidence is useful. It is not certainty. What I gave you today isn't a buy list. It's a filter. Yield alone is a trap. The monthly deposit is not the return. NAV preservation is the real test. Is your principal growing or quietly bleeding? Popular is not optimal. $45 billion in AUM is a marketing number, not a performance number. Run every income ETF you own through those 3 questions. If it passes, great. If it doesn't, now you know why. If this changed how you think about even one position in your portfolio, it did its job. Subscribe if you want to keep thinking this way. I'm not here to give you tips. I'm here to give you the framework to never need someone else's tips again.